Okay, well, welcome everyone to I guess the inaugural panel for the day. Um, if you zoom out and look at what humans are doing to the surface of the Earth right now, it's pretty astonishing. We're in the middle of the single fastest rewiring of our planet in history. We aren't just talking about money, we're talking about pouring concrete and stacking silicon at a speed that defies the usual laws of industrial gravity. We are projecting hundreds of billions of dollars in spending this year alone. But if you look closely at the gauges, there's a wobble. The dashboard is flashing red. You see, Michael Burry, the man who saw the cracks in the 2008 financial dam before anyone else, has effectively unplugged his machine. He hasn't just bet against the AI chip market, he's left the building. And here's the puzzle, the thing that shouldn't happen. The hyperscalers are spending capital as if demand is infinite, yet the price to rent a GPU is crashing. We're pushing infinite growth through a finite power grid, and the physics of energy are starting to push back. So to figure out how this machine really works, I've brought three distinct minds to the table. He is a leader at Google Cloud, and he argues that we are undergoing a phase change, shifting the world from simply renting servers to renting actual intelligence. He is Angelo Libertucci. He represents the buyers in the financial sector, and he is looking through the hype to find the mathematical moat in the madness. He is Bhavin Kapadia, and he is the CEO of Hivelocity. He is the pragmatist arguing that you can't live in the clouds forever. Eventually, the revolution has to run on bare metal. He is Jeremy Pease. So, gentlemen, let's look under the hood. For round one, I want to address the bubble fear in the rental price crash. So, Bhavin, let's start with the money. In our prep, you mentioned that chips are becoming commodities like laptops or cars. If the chip is just a commodity and rental prices are crashing down, how do investors find a moat? Is the real bottleneck no longer the GPU, but the land and power required to run it?
Yeah, no, thank you, Vish, for having me. And I'm thrilled to be part of this amazing panel. I'm virtual today, so sorry I can't be on video. But thanks to our sponsors, Google and RCR, for hosting this amazing event. Yeah, to answer your question, I think, yeah, as I've mentioned, I think there's a lot of hype, obviously, between the noise and the signal and revolution versus bubble. But I do clearly think that we're in the age of connectivity, and people want to control the connectivity, which is the roads, the networks, the land. So just like 100 years ago, when people were sensing hype in terms of building railroads and highways in America in particular, about 150 years ago, there was a lot of concern and a lot of noise. But today in our situation is no different. The geography is the same. The economic conditions are, I would say, consistent. But really, people are seeking the first mover advantage, which is the moat, which is the prime mover. And the big tech Silicon Valley companies, especially in America, know that. And if they can gain access to utilities, energy, telecommunications, then for the next decade and probably the next 50 years, they'll control everything. And they'll have that exclusive rights to control pricing, to control regulation, and to influence governments and consumers around the world. So I think I don't really see this as a hype. I think this is very validated. The numbers are validated by the investments that you'll see later on coming in. Obviously, that involves a heavy cash flow from the outset, but that will be consolidated very quickly. And obviously, another point is that there's high barriers of entry. So not a startup can't quite get into this environment today. There's too much regulation. There's too much infrastructure needed. So I'm a big fan of what's going on, and I see this as playing out very strongly in the years ahead.
Interesting. Angelo, in our discussion, you brought up the dot-com bubble, and you argued that while there were misfires like pets.com, the internet did change the world. So is Google building the internet, or are we currently overbuilding the fiber?
No, I think, my comment earlier was I don't think anyone, like if we look at just our lives today, the impact the internet has had or is having on us today, I think that was all what people ultimately thought. We probably undershot in terms of what we thought the internet could be back in the dot-com bubble, right? in terms of how, you know, the applications and, you know, the experiences that it's enabled for us, you know, years later. I think we underestimated the impact that the internet was going to have years ago. But at that time, there was also a bubble, and there were some organizations, there were some misfires. So, you know, I'm not saying there's a bubble today, but I am saying that if there is, I still believe that at the core, you know, AI becomes and is the most transformational, you know, technology advancement that we'll see in our lifetime. We're probably underestimating the impact. There will be some misfires, and some organizations will be able to withstand those misfires better than others.
Great. Maybe a follow-up question. You know, we spoke about rental yields and how they're plummeting. If those yields drop yet again, even with the new Blackwells, does your model break?
Listen, this is a pretty insightful question, right? So I'm going to give you Google Cloud's perspective. You know, we see the accelerating hardware depreciation not as a threat to the cloud model, but as the primary driver of continuous innovation and a powerful shift in value creation. So we're focused on leveraging our deep expertise in custom silicon, AI optimized services to turn that raw hardware cost into unique, high value customer outcomes. So the notion of a crashing rental price applies mostly to undifferentiated infrastructure as a service. So here, the competition is fierce and the hardware cycles are brutal, but we're now seeing our customers spend up the stack in the platform as a service layer and the AI stack where true value is found. So like that said, the AI, IaaS is an enabler to the value stack. So we're lucky to have vertical integration advantage because we mitigate the risk of rapid depreciation by designing our own silicon, the TPUs, specifically for the most intensive AI workloads. But this vertical integration provides a major cost and performance benefit that we pass to our customers. So there's also the power of scale, right? So our global infrastructure built for products like search and YouTube allows us to run these powerful depreciating assets at massive scale and high utilization, which is the most effective defense against rapid obsolescence. So in the end, the cloud model is not broken. The spend is shifting. The customer isn't renting a server anymore. They're buying the ability to instantly deploy a fully governed Google scale AI model into their application workflow using our managed platform.
That's fantastic. And even beyond the managed platform, as I understand, Google is starting to externalize TPU sales to companies like Anthropic and others.
Yes, I'm not going to, you know, are they going to make these, you know how generally available we'll make these, but yes, organizations are realizing the value, the specific value the TPU has, and we certainly see this as a growing opportunity for us.
Got it. Jeremy, you've told me that a repatriation is real. The question here is a depreciation problem actually a cloud bloat problem? If a company moves off of the hyperscaler to your bare metal, does the ROI math suddenly work because they aren't paying the cloud tax and the egress fees?
Yeah, thanks, Vish. Appreciate the opportunity to be here as well. Look, I think for us, you know, we've been in the market of looking at the value of each server for a customer. That's what this company's been built on for over 20 years. So when we look at how that impacts customers, you look at the big guys, and the big guys can say, yeah, it can go, we can go massive scale, and we'll just keep pushing that down the stack. We have a customer base that needs to know what that value is going to be for that server, and wants it on a consistent basis. They want to know what their monthly spend is going to be. They're not able to move up and down with the fact that, wait, that server's already out. Now I've got to move back. Now I've got to move somewhere else. Or, you know, you can get extra value in that new server, and we're able to give that to the customer at the end of the day. And again, as you mentioned, egress fees, that's absolutely a customer challenge. And it's one of the main reasons that customers got in, didn't understand what that was going to look like, and then come back to those of us that actually do not charge egress fees to the customers unless it's at a massive scale. And so, you know, when we talk to the customers and we look at the valuation of servers, and even if you go back to, if Bhavin is correct, and you know, servers are commodities at the end of the day, we've got to look at what is the value of that. How do we make sure we, accentuate that for the customer in a way that's useful for them, and makes sense to them at the end of the day, and is consistent for them. That's really what it becomes if it is a commodity at the end of the day. And that's why we really focus on each server as a value to that customer. And again, it still has the ability to spin it up, use automation tools, connect it with networking automation tools, and do all the same things. It's just at a set specific value the customer knows. They knows what they're paying for the specific service that they're getting, that they're dedicated to them. There's not any type of a shared environment. And that, that allows them to utilize that resource as necessary with a consistent price on it.
Got it. Let's go to round two. And round two is, where does the compute actually live? Training versus inference. It's all about location, location, location. Angelo, let's start with you. You mentioned that the future is a hybrid model. So the question here is, we heard about edge AI, but Google is building massive centralized training centers. So why would a customer keep data at the edge? Is it latency, or is it simply that they can't afford to move petabytes of data into the Google Cloud?
Yeah, so this is an excellent question. We're a firm believer in inferencing. We're actually, I think, still today provide the only large language model that we can actually deploy on-prem with Gemini on-prem. So we are already engaged with customers on that front. But the question gets to the heart of current AI infrastructure debate, right? So the short answer is, we're not building the wrong thing. We're just building the first thing. So the future is almost certainly a hybrid model where centralized training is essential for enabling distributed inference, right? So massive centralized data centers, like for training, are still critical because of the power law of scale. So the most capable AI models obey a scaling law where better performance comes directly from exponentially more data and compute. So state-of-the-art large language models require thousands of the most advanced GPUs, TPUs working in perfect coordination for months, right? So centralized systems are the most efficient way to collect, clean, and utilize petabytes of data that are required for foundational model training. While training is centralized, though, right, we're at the early stages of witnessing AI usage, which is inference, moving closer to the user or data source, driven by some of these technical and business requirements. Where that edge actually is, I still think is debatable.
Right.
But clearly there will be inferencing requirements, even if you look at 3GPP standards, at 6G networks. They actually describe the requirement for AI inferencing at the edge. So there might be reasons like latency. So process, where you need to process data instantly, and then eliminating network lag for whatever application, privacy or security, so sensitive data, video, medical records, never leaves the local device or the premise. Bandwidth, right? You might want to reduce the amount of data that needs to be sent to the cloud, or even resilience, right? It continues to function even with intermittent or zero internet connectivity. So overall, we're moving towards centralized training with distributed inference. Right.
Jeremy, you serve clients in gaming and streaming who actually live at the edge. So the question here is edge AI just marketing hype, or are you actually seeing companies deploy inference models in distributed locations today? And what are they actually doing?
Yeah, absolutely. No, I mean, when you look at, again, it's such an easy one for people to consume in terms of what does it really mean to be at the edge. You think about people that are playing games at their home, or you're streaming, all the different platforms from Hulu to Netflix to all those different pieces. That really is the edge. That is about getting the technology to the users at the end of the day. And so that's where companies that are really focusing on this are putting that to action. And so when you think about, as Angelo said, absolutely, there's these massive facilities that are doing all of the training models. But then once you actually want to get that out to all of the end users, think about, the end users that are using these chat models and all these different things. That's great. But it's got to be able to get to the end user in a way that they can actually utilize that, and for all the people across the globe to be able to utilize that. But you think about, as we've expanded, and there are actual, self-driving cars now, right, that are out there. that's actually an edge case and an edge model where, you know, you're not doing the training live, but everything that you share with that car and what it shares back to those training models is part of that. And so that's distributing that to what we would consider the edge. But when you really look at where enterprises are spending their money, it's where they can save money at the end of the day to justify the ROI on the spend. And so when you think about that, you think about, you know, people that are shipping and distributing information or collecting data and information on consumers at the end of the day. If Amazon can save, you know, 1% of their overall revenue based on something that they've learned from AI models that are managing everything in distribution, that's a huge impact to the overall business and worth the ROI on the spend. So when you think about manufacturing, distribution, all these pieces, these are all the different examples of where AI is actually playing at the edge. So it is very real, but as Angelo said, we're very much learning what that means, how it needs to be utilized, what type of pieces are in that. Because if you look at the overall AI game right now, training is 90+% of the overall business of AI, and we're just learning about inference now. So there's a lot still to be learned on the AI inference front in terms of how we distribute that to the edge, but it is very real. Companies are utilizing it. It's just a little different than I think most people think about when they think about AI at the edge and how people are actually consuming it.
Right. I mean, it feels like an evolution that's fairly logical. We're starting, in these centralized data centers where, to Angelo's point, we've got scale economics. And so the cost per inference is fairly low. When you go to the edge, the cost for inference starts to skyrocket and you have lower utilization. And so you don't really benefit from the same types of cost points that you would at the edge. And so you have to be very, very calculated in terms of where you deploy it. And so we're still testing that out in the industry.
Absolutely.
Bhavin, does the financial sector care about where the model sits, or do they just want the cheapest possible inference?
Yeah, no, that's always the thing, right? I mean, regardless of financial services sector, banking sector, or even big tech, I think ultimately what corporate companies always are striving towards are minimizing the cost per head, and gaining momentum, building long-term investment. So we see that GPUs obviously will be becoming less and less of a niche, less of a specialization. There'll be write-offs eventually, and they'll convert into liabilities. But the assets on the balance sheets will be offset by any losses. I also think that in terms of data centers, we also need to take into account neo clouds, and they are a little bit different than Angelo's Google Cloud firm and other hyperscalers, but they offer something really, really attractive in terms of how they are a little bit more agile, a little bit more nimble, and maybe more regional focused rather than global and nationally focused setup. So the financial services sector, I think generally speaking, don't really care about how it's being set up from the outset, but it's what comes, how the cash flow models are built up on the endpoint and the techniques that they've been using. And obviously, NVIDIA and other firms like that have been building out these models for decades now, and they know that the return on investment is going to be coming down the pipeline in a very robust and dynamic fashion.
Gotcha. You did mention these neo clouds, and there's certainly a lot of them in the headlines today with CoreWeave and certainly FluidStack. They tend to be specialists. Some of them are converted Bitcoin miners who do have location advantages. There are also some talk about sovereign cloud in the mix. Can you maybe give a bit of a perspective of how much do each of these things matter in terms of the benefits that these neo clouds bring to the industry, whether it's latency, whether it's compute efficiency, whether it's geographic isolation?
Yeah, no, those are all valid. I mean, I think that's what makes them very attractive these days, and how they've almost exploded into popularity, because they do offer obviously latency benefits. Like when I used to build out these trading platforms for institutional banks, I mean, ultra low latency was a big thing even more than a decade ago. And banks and institutional managers were building out NASA spaceship types of data centers even back then. So they've been ahead of the curve really from the foresight. But yeah, in terms of latency, that's a big thing. They offer more elastic in terms of their workloads, performance. GPUs are a little bit more scalable, more manageable, and more customizable. But in terms of sovereign clouds, I think you're seeing the Middle East really power that ahead. And here, where I am based in the UK in London, sovereign is a big thing. I was at a conference recently a few weeks ago with a big data center provider who are really trying to court and woo sovereign governments in building out their infrastructure. And it's a really, really amazing conversation. And when they say there's a race going on, there really is an arms race in AI, whether you want to talk about it from a corporate standpoint or a sovereign cloud provider or government standpoint. It's a really, really big thing. And I think the UAE and Saudi are probably at the forefront of that and cutting edge in terms of leading the race from a very holistic perspective. So it's a really thrilling race that we have, and it's something that I'll be watching very closely in the next year or two in particular.
Great, thanks. Let's go to round three. I call this the revenue gap. Sequoia Capital recently made headlines by saying that there's a $600 billion revenue gap relative to the infrastructure spend that we're seeing at a run rate of around 200 billion year over year. At least certainly that's what the forecasts are saying. If you look at the price to earnings ratios of the Magnificent Seven, built into those assumptions seem to reflect an earnings potential of trillions of dollars by 2030. We want to talk about making money versus spending money. Jeremy, you mentioned that boring AI, logistics and manufacturing, has probably the clearest path to revenue than chatbots right now. So the question is, why are the unsexy use cases winning the ROI battle?
Yeah, I think, Vish, I kind of mentioned that in the last one. I overlapped the two, but I think it really does come back to where can the ROI truly be? I mean, spend has to have some kind of value to the customers at the end of the day. And again, when you talk about big manufacturing, big distribution, and the capabilities that brings in terms of saving to the overall, bottom line, and what it can mean in terms of being able to distribute quicker, being able to get more information, be able to gather that for their customer base. I mean, that's where the money is made. And I mean, you mentioned 600 billion. I think OpenAI just announced that they're going to have to raise about 700 billion just to be able to make the gap between where they are right now and what they've committed to in spend with the massive providers. And so I think, that is the boring piece of manufacturing, logistics. These places are where they're able to actually make money off of this AI right now, and put a return to the business. But if we go back to where is the bubble in all of this, if there is a bubble, I think it comes back to what you pointed out in the very beginning, which is if you look at the neo clouds and you look at their returns and you look at how things are, falling off in terms of rental prices and all of that, they're committing way ahead of where revenue is coming in, as well as even the AI providers that are signing a lot of those contracts are putting that into infrastructure well ahead of anything that they can actually make on that. And so I think if there is a bubble in all of this, that's where it is, because places that are actually spending it on AI that can make money back on it and have a clear path to revenue for that or savings to the organization, that's who's utilizing AI to the full extent right now. The others, that's where, does it come? Does it not? Do they find a way to monetize it to be able to get to that type of revenue to justify that type of spend? I'm not sure at this point, and that's why I believe if there is a bubble in all this, that's where it is.
Yeah, it's a bit jarring to see the outpacing of spend relative to the power cycles that you have in the industry for silicon. Like if you deploy an H100 today versus the Blackwell, you're suffering from some pricing arbitrage. The cost just to power that H100 relative to the revenue from inference is a bit of a bit of a problem relative to the power that Blackwell would take relative to the cost of the inference. And that inequality at the center, that equation that isn't balancing, is, I think, creating quite a bit of stress across the investor community.
Absolutely. No. And I mean, you look at that, and even just OpenAI being at 700 billion that they think they have to make up. And as you mentioned, what is the revenue that's sitting out there from what can't be delivered today, across the big four in terms of hyperscalers? That number is close to $700 billion right now. I mean, we're talking about hundreds of billions of dollars, well surpassing the midway point to a trillion. It's concerning. Does it all shake out at the end of the day?
Exactly. Angelo, Google sees the data. Are we seeing a shift where customers are going to stop piloting and start deploying? And where is that revenue explosion going to come from that fills the CapEx hole?
Oh man, we see the data. Well, we don't actually see the data. Just customers' data is always, at least when it sits in Google's cloud. But yeah, in terms of overall, we continue to work with our customers in building new experiences for their customers, and it's an exciting time. Like today we announced with Estee Lauder, I think, like one of the first most innovative application and use cases where they're taking our platform in Gemini and taking natural language and translating that into what that means from an olfactory sense perspective, and making fragrance recommendations, as an example. So these are the focus areas that we have with our customers. As it relates to Google and Google services ourselves, we are, related to this investment, we're fortunate enough in that we have what I would say a quite healthy business, with billions of users across, ads, YouTube, search, etc. And those businesses are going to cautiously help us fund kind of the investments we need to make in the areas that we feel our customers are going to get the best experiences and the greatest value, and those are the services that we're focused on.
Yeah, I mean, back to, I think, a point that you made earlier. You guys are a systems company. You're vertically integrated across the infrastructure and the applications, so that you really do have one of the better perspectives in terms of where is that revenue going to come from. Bhavin, maybe shifting to you. There's definitely no one in the world who would accuse the financial sector of not understanding risk. When you take a look at these outsized investments that are being made to build out the infrastructure layer, how do you calibrate that risk in terms of where the revenue needs to come from?
Yeah, no, that's a very, very. I think that's where the balancing point is. But I would just say, generally speak, from a macro view, I think it also depends on which region you're looking at. And because over here in the UK, in London and Europe versus the US is very different market in terms of revenue generation. Because you're in Europe, in EMEA, you're looking more at the regulations side of things, the regulatory landscape, which is a lot more constrained, a lot more less, people might say, anti-business in terms of, but more focused on sustainability and cooling issues and net zero and decarb, whereas in America it's less concern about things like that in terms of regulations and sustainability issues. So it's really the cash flow modeling and the investment side of things, it comes a little bit more different in terms of the outlook when you're building out those techniques. But from the investment standpoint, as I alluded to earlier, once you have that foothold in the market, which the big five or big seven will come on, the investments will pay off and generate in itself. So it's a really easy sell, even though you're constrained by the region that you're targeting. I obviously, in the Europe region, even though the American companies want to target and dominate the European regions, they're having to deal with a lot more issues, a lot more obstacles, a lot more issues that aren't quite being placed in America's side of things. So it's a little bit trickier, a little bit more sensitive issue. But I think you also have the backing from governments on both sides of the Atlantic that they both want to do really, really good. And they know that building the infrastructure and architecting it is the way of the future because everything needs to be connectivity. And I think the other day I just heard about a country in Northern Europe, in Scandinavia, who's building an underground infrastructure setup with fiber and 6G and everything like that in telecommunications. So I think it's a really, really attractive time. And you mentioned earlier in terms of a hedge fund manager earlier who was shorting the industry. I actually think that for some reason, things like that get headlines because it's not really that big of a deal. Throughout the last 10, 20, 30 years, institutional money managers are always shorting a stock. But that's only because it's very cheap to do. It costs pennies to short a stock. But the payoff is enormous. So if you, even though it just costs a few pennies to say, oh, okay, this tech sector is going to go bust in a few years' time. If you end up being right, there's an enormous amount of payoff. So it just gets headlines, and you don't even have to be technically very skilled to do that. Even an average consumer in the stock market can do that. And if they want to make a really enormous return, they can do that. So for some reason, the media is captivated by things like that, but it's been going on for 20, 30 years. And if you're really lucky, you hit the jackpot with very little skill, by the way.
That's right. Well, everything gets amplified by the AI machine, particularly with the money that's in play. Let's move around for, I call this the physical reality, the power in supply chain. We want to talk about the constraints. Jeremy, you mentioned that power is the new gold and that getting chips is still a nightmare. The question is, we talk about booked out but not billed revenue. Are we reaching a point where you literally can't plug in the machines you want to buy? Is the grid the ultimate ceiling for this industry?
Yeah, I mean, the grid and chips are the key to the future of this industry, plain and simple. I mean, that's where it is. I mean, when you look at the amount of power that's necessary, and as these new chips consume more and more power, look, in the data center industry, 5 years ago, we still thought 50 megawatts to 100 megawatt was a massive facility, and even 10 years ago, 20 to 30 megawatts was a pretty large facility for most data center players. And now we're talking about 500 to 800 gigawatt facilities, or 500 to 800 megawatt facilities, gigawatt facilities plus, right? I mean, it's a totally different ball game now. And when you talk about, when you think about that, you go power per rack. And maybe I'm going too far into the weeds from a data center player, but like 5 kilowatts to 10 kilowatts per rack was what we saw on a normal basis that was on the larger side. And now we're talking 200 kilowatts per rack. I mean, it's completely changed the way that we think about things and the way that we think about power and what's necessary. And the grid was not built to be able to handle that. I mean, I'm here in Texas, and I mean, a couple winters ago, we couldn't even handle the power grid when it was cold, and there were a number of data center players running on, gas for a significant period of time. And so these massive players that you talk about, the neo clouds, they're going out to regions that have never had to have the demand of power that we do in the tier 1 markets. And that's where they're able to get some of that power. But in some of those tier 1 markets and even tier 2 markets, the power is extremely constrained. Being able to get what you need is extremely difficult. And when you do, it's 3 to 5 years out. I mean, that really is the realistic part of it. And getting the chips on top of that. I mean, you can get the chips before you can get the power in most cases. Let's be honest. And so, I mean, that's why there is this massive, whatever, like you said, booked but not billed. I know some of the hyperscalers come up with a new term for that, but it's in the hundreds of billions for each of them to be able to deliver on that. And even the neo clouds and OpenAI and like all of these companies that are working through this are really trying to figure out where they're going to get that power from. Where the chipsets are going to come from. But yes, power is the new gold, and it's so interesting because when I explain it to my parents or anybody else, internet is now like what power was back in the day. Before we had power, nobody thought about what it would have been like without power, and now we think about what it wouldn't be like without internet. So it's interesting that power is the limiting factor now to expanding the internet when you think about it in that context.
Great. Power is definitely that pillar of the AI economy. Certainly, it's not a monolith. There are certain geographies that have a lot of power and others that don't. It kind of brings me to the next question, was it brings in this East versus West dynamic. To Angelo, when we look at the the West strategy, we're trying to build out these massive LLMs. We're really going after the cognitive stack. If you look at what's happening in China, they seem to be building out an industrial AI, more towards robotics and EVs. They have plenty of power. They have got excellence in robotics. They're almost running a play where they're trying to commoditize the intelligence layer with their open weights models that they've been publishing. If you're betting on long-term economic dominance, are you betting on the chatbot or the robot?
Oh, complex geopolitical question. And I think it depends on what your definition of winning is.
Right.
But I think, yeah, the short answer is the West, in particular the US, certainly appears to be leading the cognitive AI chatbot war, and the industrial electric AI race is more nuanced, but China holds significant strengths here. So if we look at the cognitive piece of it in the West, it's driven primarily by major US tech companies. We're currently the clear leader in the development and deployment of large language models and generative AI, which form the core of advanced chatbots, right? So the West has a chip advantage, access to and development of the most cutting edge, high performant TPUs and GPUs, essential for training massive models. If we look at the talent ecosystem, the West has vast, interconnected ecosystem of academic institutions, venture capital, tech giants. These are all fostering rapid innovation in core AI research. And then based on current LLM metrics, the world's most powerful and widely used LLMs are all developed in the West. So China has its own powerful models, but they generally trail the performance of the leading Western models, especially in complex reasoning and multimodal tasks. Now, when we look at the industrial electric AI war, I think it's a much more complex battle where the definition of winning depends on the metric. Is it volume, cost? Is it cutting edge R&D? But China obviously holds a significant, arguably dominant position in the deployment and scale of industrial AI. So, China has EV market dominance, right? The world's largest electric vehicle market and producer. Massive scale allows them to rapidly iterate on battery tech, manufacturing processes, the self-driving AI systems. They have robotics volume. They're the largest purchaser and installer of industrial robots globally. They often use older, proven chip technology to drive reliable, large volume manufacturing automation. And they have supply chain control, right? They have control over the critical raw materials and battery supply chain needed for electric vehicles and industrial electronics, right? Massive cost advantage, logistical advantage. So the verdict is like China is winning the war on scale, cost, and immediate industrial deployment. The West is leading in the most advanced, future-facing, hardware chip simulation tools that drive the next gen of industrial AI, right? So it's more accurate to say that the two regions are specializing in different technical and technological areas. But we need the West, like we're winning the chatbot war, but we need to translate that cutting edge AI and chip advantage into concrete industrial output, right? Like affordable electric vehicles, automated supply chains, to avoid losing that industrial war, right? If we use the metric of global market share and manufacturing dominance, we run the risk of losing that industrial war long term.
Great answer, Angelo. I mean, it's where are the rents going to accrue, to your point? Is it going to be productivity gains on the electric layer, or is it going to be gains that come from the LLMs themselves, the cognitive stack? And maybe it's both, or maybe it's one that wins out. It's hard to say at this point, but fantastic analysis. We just have a few minutes left here, maybe 1 minute. So let's do a lightning round. I want some brutal predictions, no hedging. Look 3 years into the future. Let's start with you, Bhavin. Do we see a bubble pop, asset write-downs, or does the ROI catch up?
ROI definitely catches up, and I'm a big long-term advocate for that. So I think all the audience people shouldn't get too distracted by the hype and the media, and just focus on the good fundamentals and look for the history for similar situations that we've been here today. So thanks I enjoyed today's session. Thank you.
Great. Jeremy, same question.
Yeah, I mean, look, I think, I think 3 years out, we're probably at a plateau. I don't think there's going to be this big boom, but I think there's a plateau that we hit at the end of the day. And some will drop off, but I think most of the big pieces will stay here.
Great. Angelo, same question.
Same answer as Jeremy. I think some will survive, not all, and will level off in 3 years.
Fantastic. Well, gentlemen, thank you very much. I know the jury is probably still out, but the stakes are just so incredibly high. It was fantastic to hear your insights, and thank you for sharing them with the team. Manel, I think, has given us a few questions here. I don't know if we have any questions. Nope, I don't think that we have any time either. So I'm going to maybe disband the panel for now. And thanks for everyone who joined. And thanks to these wonderful speakers for sharing their insights. Thanks, everyone.
Thank you.
Thank you. Thank you.